In this video, we will go over the accounting equation, which is assets equals liabilities plus owner's equity, a very important concept. It is one of the foundation of accounting knowledge. So, what are assets? Very simple. Resources owned by the business. Think of building, furniture and fixture, equipment, inventory, cash, vehicle. Very similar to you and I. We may have assets like jewelry, shoe collection, piano, TV, car. Any business that starts off will need funding. Owner injects fund into the business. This is called capital. The injected fund is an asset called cash. Let's say it's $100,000. In owner's equity, capital is also $100,000. We see that the accounting equation balances. On the left side, assets made up of cash is equal to owner's equity made up of capital. To get the business going, the company purchases a car. Car is an asset. Let's say in this case it's $30,000. How was it purchased? It was purchased using cash. Cash is an asset. So cash decreased by $30,000. The total assets still remains the same, $100,000. However, the component of assets is now made up of car, $30,000, cash reduced from $100,000 to $70,000. The sum of $100,000 minus the $30,000 used to purchase the car. Next, the company needs to invest in a machine, and this machine costs $50,000. How is this machine purchased? Company have $70,000 in cash, and machine costs $50,000. That would leave the business with only $20,000 remaining. Company decides to finance most of this machine, so it puts a $5,000 down payment in cash. It finances the remaining amount, $45,000. And the account we use to record that would be something like machine payable or loan payable. We must ensure that the accounting equation balances. On the left-hand side, $45,000. On the right-hand side, liabilities and owner's equity, also $45,000 in this transaction. Each individual transaction balances. And the total of all transactions also balances. Total assets sum up to $145,000. Total liabilities plus total owner's equity also $145,000. The takeaway is that companies have many different assets. There are a variety of different accounts, different liabilities, and owner's equity. So we see that companies have all these different assets, but not necessarily all these assets, they have equity in them. They may have assets but financed, meaning that it's payable, meaning that it's an obligation that must be repaid back to the lender, to the creditor. Extremely important concept is that the accounting equation must always balances, meaning that each individual transactions, when it's recorded, must balance. Assets must equals liabilities plus owner's equity. And then in totality, all total assets equals all total liabilities and total owner's equity.